Welcome to Alpha Recap, your end-of-day markets rundown from stockalpha.ai. We're closing out the week with a lot to unpack after a hotter-than-expected wholesale inflation report shook things up. As always, if you have questions, you can reach us at stockalpha.ai.
Thanks. Big day. Markets closed the week in a clear risk-off move after that wholesale inflation surprise. So, what really stands out here is how immediate the repricing was.
Right. Friday, February 27th. Traders pushed up the odds of a higher-for-longer Fed path, and the effects were across the board. We saw banks weaken, big tech slip, and microcaps explode into winners and losers.
To be specific, Bank of Hawaii finished the day down about 5%, and Axos Financial fell roughly 9%. And get this, NVDA finished down about 5.5% to roughly $184.89 on volume of about 355 million shares.
That NVIDIA print really mattered. Heavy volume with a notable decline? That's institutional activity, or at least large-scale repositioning. It's not noise.
Exactly. And on the microcap side, we saw wild moves. ENSC jumped about 58% on about 278 million shares. Core surged about 79% on roughly 3 million shares, while penny CRESW plunged about 60% on only about 4,000 shares. Wild day.
Yeah, that tracks. Those micro moves highlight the split we saw. Heavy volume institutional de-risking in large caps versus headline or retail-driven booms and busts in low-float names.
Right, and another nuance. There was an institutional block sale carried in the tape. North Run sold about $3.6 million worth of Lightpath. For a small optics name, that matters. Small ownership events like that can push a thin stock a long way.
Short reaction? Wow.
Short reaction? Not great.
Let's step back and explain why wholesale inflation mattered so much. Wholesale inflation tracks price changes earlier in the supply chain. Think producer prices and input costs. When those accelerate unexpectedly, it increases the risk consumer inflation stays sticky, which raises the chance the Fed keeps policy restrictive.
Put more simply, higher wholesale prices can filter into higher costs for companies and eventually consumers. That pushes up implied interest rates, which in turn raises the discount rate investors use to value future earnings. Long-duration names feel that most.
Exactly. So growth and tech names got hit because future profits became less valuable today. Banks got hit because higher rates can squeeze loan growth and increase potential credit costs, especially for regionals and digital banks with fragile deposit profiles.
Yeah, digital banks like Axos can be more sensitive because deposits and funding can reprice quickly. And regional banks, like Bank of Hawaii, face a double whammy: wider funding costs if rates stay up, and a risk of slowing loan demand if growth softens.
Honest observation. I was a bit surprised by how synchronized the move was across sectors. Institutional flows were obvious. Again, that NVIDIA volume tells the story, while microcaps acted almost independent, driven by concentration and chatter.
Totally. There's this bifurcation: large cap heavy volume de-risking versus microcap frenzies. Volume is your reality check. If a big name moves on huge volume, that often reflects repositioning or forced trading. If a tiny stock rockets on little volume, that can be illiquidity or headline chasing. High reversal risk.
Short reaction, big move.
So who's arguing what about this? There were two main camps Friday. One says this was a knee-jerk repricing that will reverse if upcoming data softens. The other thinks Friday marked the start of a higher-for-longer regime that forces lasting portfolio adjustments.
Yeah, and the deciding factor is the data sequence. Next, CPI, PCE, and retail prints, plus Fed commentary, will really determine whether this was a blip or a regime change.
And there's disagreement about microcaps too. Some traders call ENSC and Core genuine breakouts backed by momentum. Others call them classic pump and dump or short covering in low-float names. So it depends on your time horizon and appetite for risk.
Microcaps can be brutal. The CRESW drop on barely any volume shows how tiny liquidity can produce outsized moves that may have zero informational content.
Right. Ownership concentration matters. That North Run sale of Lightpath was only about $3.6 million, but for a thin stock, that kind of exit can trigger outsized pressure as algorithms and momentum players pile on.
Let's turn tactical. Who should do what after Friday's action? For long-term buy-and-hold growth investors, big-cap pullbacks like NVDA could be opportunistic if fundamentals are intact. But reevaluate position size versus the possibility of a higher discount rate backdrop.
Income and value investors had a decision too. Rising rate uncertainty is a two-sided sword. Higher rates can help banks' net interest margins, but if rates stay elevated while growth slows, credit quality could deteriorate. Focus on balance sheet strength and loan mix.
Short-term traders and volatility seekers. Friday offered setups, but also elevated weekend gap risk. Remember, markets were closed on Saturday, February 28th, and they will reopen Monday, March 2nd. That break raises the chance headlines over the weekend create big gaps on Monday.
Retail speculators, be cautious. Microcaps with huge percent moves on low liquidity are dangerous. Size positions small, use limit orders, and be ready for sharp reversals.
Institutions. You should be stress testing duration exposures and looking at hedge effectiveness. If a higher for longer Fed is in play, options and swaps can help, along with reassessing liquidity buckets.
Now for some practical tactics everyone can use. First, reassess duration exposure. If you're heavy in long duration equities, consider hedges or staggered buying on validated weakness. Second, trim over-concentrated small-cap positions. Quantify exit costs.
Third, watch the weekend for headlines. With a multi-day close, the risk of a jump on Monday is real. Fourth, use volume to quality check moves. Heavy volume in large caps is more informative than huge percent moves on tiny volume.
And fifth, monitor incoming macro prints and Fed communication closely. If data moderates, risk assets can bounce quickly. If data stays hot or gets hotter, expect broader multiple compression and consolidation.
I mean, when you step back and look at this, the core takeaway is about distinguishing liquidity-driven moves from information-driven repricing. That's how you decide whether to buy, hedge, or hold.
Yeah, and practical rule of thumb, treat heavy volume declines in liquid names as likely institutional repositioning. Treat massive swings in illiquid names as headline or order flow driven. Higher reversal odds.
Final quick reactions.
Short reaction. Be cautious over the weekend.
Short reaction. Size matters, especially volume.
Before we go, let's summarize the clear takeaways. 1. Friday's wholesale inflation surprise triggered a cross-market risk-off and repricing of duration and credit risk. 2. Heavy volume moves in big names signaled institutional repositioning. Extreme microcap moves often reflected illiquidity and concentrated flows. 3. Weekend gap risk elevated. Markets were closed Saturday and reopened Monday, so monitor headlines. 4. Tactical actions. Reassess duration, trim concentrated small cap bets, use volume to vet moves, and watch the upcoming data slate.
Those are solid takeaways. If you have questions about anything we covered today, head to stockalpha.ai where you can ask us directly, and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for listening. Have a good weekend, and remember, defense and selective rebalancing with a prudent posture after Friday's action. We'll catch you on Monday after the reopen.